Hello, everyone. I'm Garrett Monroe, sell-side managing director at Calder Capital. I am joined today with Randall Hesselink, partner at Helmholdt Company. Today's topic is going to be centered around tax and why tax, and specifically tax structuring, tax savings, is important in the sell-side M&A process. So Randall, thanks for joining.
Thanks for having me.
I wanted to go through three very brief questions just to tee up some of the main conversation points that we hear from sellers. The first one is, why is it so important for business owners to bring a tax professional into the sell-side M&A process early, sometimes years before they plan to sell?
Garrett, again, thanks for having me. And it's a great question. It's something we run into quite often, as you guys do. So when you're selling a business that's been in the family for 60 years, it's important that you put enough time and effort into planning for that sale, right? Because most clients that we deal with are looking to maximize the profit, right, on the sale. So a couple things to keep in mind, you want the strongest set of financial statements that you could give to a prospective buyer, and that's typically going to be at least 3 years. So if you're coming in looking to sell in a year, what do your financial statements look like? Another side from a tax planning standpoint, we come across a number of new clients that are not utilizing certain tax credits, for example, like a research and development tax credit. So we might have a client that, could utilize $100,000 or even a 7-figure R&D tax credit. That could be a huge selling point to a potential buyer. So those are a couple of the main items. Other things to keep in mind that you need to be planning for is, out of the proceeds, are you going to be looking to be charitable? Is there estate planning that you can be doing with the next generation? So it's incredibly important to bring that the planning in early enough so that we can get involved and give the advice that you guys are looking for.
Yeah, so I think to your point, Randall, it's good to get involved early because you don't necessarily know which of those strategies you're going to implement. But you might implement all of them. You might implement some, maybe one or two. So it's good to hear that at least there's options for business owners if they start planning early. The second question I have is, can you share examples of tax planning strategies like entity structure changes that have significantly reduced the seller's tax liability in a transaction?
Certainly. Recently, and over the last 12 months, we've actually come across this a few times, and that's where we've converted a closely held C-Corp into an S-Corporation. And the primary goal of that is the C-Corp, when you sell your stock, it's subject to a 3.8% tax at the personal level. And if you're an S-Corp, you avoid that tax completely. So on $1 million gain, there's $38,000, which, maybe doesn't seem significant, but it can add up quickly. So that's something we've come across a few times recently. There's another tax provision that was extended and greatly improved under the recent tax bill, and that could potentially even allow for a C-Corp shareholder to sell their stock at a 0% tax rate. In today's world, there's not much that you can find with a 0% tax rate. So yeah, we've actually helped structure a couple clients in the last 6 months to go that route. And, if they sell the company in 5 or 10 years, there's a potential that they're not paying any tax on the sale.
Yeah, so awesome. I've seen that as well. To your point, very rare. How can the way a deal is structured in the LOI, such as asset sale versus stock sale, impact the seller's taxes, and what should they be aware of?
Yeah, so an asset sale is when is what the buyer's primarily looking for, because they're looking to maximize their write-offs as quick and as much as possible, and that's where the asset sale comes in. The buyer, they want capital gain treatment, so they're looking to sell their stock. So typically, on a $2, $3, $4 million transaction, you're talking potentially $300,000, $400,000, $500,000, anywhere in between in terms of the difference between an asset sale and a stock sale to the net proceeds that the seller receives. So typically, you want to have that nailed down up front when you're looking at an LOI and the terms in the LOI, because if all of a sudden on a $3 million transaction, you're arguing about $300,000 to $400,000 adjustment, a month or two in, that can cause the deal to go south quickly. So you definitely, for the seller, you want to look for a stock sale if available. And if the buyer is pushing for an asset purchase, then the seller needs to use that as a negotiation to bump the sales price up to account for the difference. So definitely something you want to keep in mind ahead of time and get the LOI to your benefit as a seller as much as possible.
That's very well said. So to summarize today's video, it's very important to get someone like Randall involved very early on in the process. The two big things are going to be, it's going to help speed on the market if you have everything set up from a tax perspective. And then there's also significant savings that you could be leaving on the table. So make sure to get a tax professional on board on the team as soon as possible to make the deal process go smooth when we decide to pull the trigger. Thanks for joining a Calder sell-side Q&A video. We look forward to seeing you next time. If you enjoy learning more about Calder Capital and our sell-side advisory practice, you can contact or find us on the details listed on the screen. We look forward to hearing from you soon.